Okay, everybody, we're back to go over more topics regarding leases and, in particular, finance leases. So let's go to page 1251. Notice here it says depreciation. The depreciation period is the period of time that the lessee will use the asset. Okay, so it's the useful life to the company. Okay, so when we go here, our useful life is how long we are going to use the asset for. The economic life is how long that asset can reasonably be expected to be used in the field. So we might say our useful life, we're going to use this asset for, I don't know, 3 years. Okay, but you really could, the economic life, okay, so the useful life is 3 years, economic life, I don't know, maybe 4 years. Okay, so if we're just using that criteria to determine is this lease a finance lease or an operating lease, 3 divided by 4, that's going to give us 75%. So it meets this criteria of being greater, the useful life being greater than 75% of, equal to or greater than 75% of the economic life. Again, that is it's a rule of thumb. You might have to combine it with others to really determine is this a finance lease or an operating lease. But I mean, it's just going to help us to determine. You never make a decision based on one item. You're going to have to look at every other lease criteria of how you're going to classify it. Okay. So let's look at the page at the top of page 1251. So let's just look at case 1. Okay. So it says here the lease term, including the bargain renewals, because we always have to include our bargain renewal lease options in the useful life calculation. So if we look at this case 1, okay, we have our lease term is going to be 5 years. Okay. The economic life of the leased asset is 8 years. Okay. So the lease term is its useful life. Okay, so basically we're just going to go 5 divided by 8. That's going to be 62.5%. Okay. So it's not hitting that greater than 75% of the economic life criteria. Okay. So is there a bargain purchase option included in the lease? No. Okay, so we're not getting this. We're not getting this. Now, I don't think we have enough information to determine if the present value of the minimum net lease payments are greater than 90% of the fair market value. It says here, no, there's no indication. Again, we're just trying to do some quick calculations here to, again, help us determine the criteria of a lease, again, using different depreciation periods. Now, if we go look at case 2, the lease term, including bargain renewals, is 5 years. The economic life of the leased asset is 8 years. The depreciation term that we want to use is 8 years. So 8 divided by 8, that's going to get you 100%. So that would be capitalized, right? Obviously, that's greater than the 75%. Okay. So in the textbook here, it says, in case 2, the lessee has a bargain purchase option and so will control the asset after the end of the lease term. So not only is this a finance lease because it has a bargain purchase option, okay, but also we're at that 100% range. Now, assume that the lessee will continue to use it, the asset would be depreciated over 8 years, okay? So we've really got to look at, again, there's the lease term plus a bargain purchase option, okay? Now, if we were to just look at the lease term on its own, 5 divided by 8, there's no way it's going to be at 65%. But now we're set to add in other things. Yeah, there's a bargain purchase option. We're going to use that asset fractionally for 8 years because our plan is to not only use it for the initial 5, but also after we gain control. Okay, so that would classify as a, just using these two criteria here, okay, it would classify as a finance lease. Now, case 3, lease term is 5 years, economic life is 4 years, choice of depreciation 4 years. Okay, well, we can't have a situation, okay, where your useful life is greater than the economic life. Okay, so in this case here, the economic life is 4 years, and this is the maximum depreciation period. So the economic life is 4 years. We're going to depreciate it for 4 years. Now, I'm not sure why the lease term would then be 5 years, but it is what it is. So it says, in practice, case 3 is highly unlikely. Okay, economic life is typically longer than the lease term. You know, obviously, after all, why agree to pay for an asset after it has stopped being useful? Okay, so again, we've got to take into consideration various factors to determine, is this a lease, a finance lease, or an operating lease? So criteria 1, 2, and 4 are very easy. Okay, why? Well, is there a bargain purchase option? Yes or no? It's not complicated. Okay, that useful life calculation, all we're doing is we're taking our lease term, dividing it by the economic life. Okay, our useful life, how long are we going to use it for, divided by, again, that economic life. How long do they think, does the manufacturer think that thing would last? Okay, so you do a quick calculation there. If you're above, in and around 75% or higher, okay, boom, it's a finance lease. Okay, now what we haven't done is we haven't looked at point 3. Okay, and a highly specialized piece of equipment, that's just the obvious. The narrative is going to say this is a highly specialized piece, there's no market for it. Okay, if that was the case, then it would automatically trigger to be a finance lease. Okay, something a little harder is this one here, number 3. Present value of minimum net payments. Now, that's what our assignment or questions today are dealing with. We're getting this information. Now we need to analyze it. Is it going to be a finance lease? Because if it's a finance lease, we have quite a bit of journal entries we need to make. Okay, so let's look at the scenario given on page 1252. Okay, so we have a finance lease illustration. So let's look at the lease terms. Fair value of the asset is $66,000. The lease begins on January 1st. The initial lease term is 3 years. The economic life of the asset is 8 years. All right. Okay. So first of all, we don't know. Is there a bargain? I'm going to just read all of the points. Payments over the initial lease term are $20,000 per year, payable at the beginning of each lease year. That is an annuity due payment. It's due at the beginning of the year. Okay, we got to remember the difference between annuity due and a regular annuity payment. Okay, we can mix a little bit of corporate finance in there now. So for 03, 02, 03, and 04, they're going to pay $20,000 a year. Okay, so that's going to set up our present value calculation. At the end of the initial term, the lease is renewable for another 2 years at the leasee's option, $5,000 a year. So we go from making 3 annual payments of $20,000. The remaining 2 years, okay, we're going to have to only pay $5,000 a year. Now, assume that the normal rental cost of 3-year-old equipment of this type of lease is almost $10,000 a year. Okay, that might come into play. Okay, is it a bargain? Not really. Now, the lessee is responsible for insuring and maintaining the equipment. That's important. Why? Well, because when we make that journal entry, we do not include repair and maintenance expenses in the present value calculation. Okay. Now, the lease reverts to the lessor at the end of the lease. The lease agreement contains no obligation that the leasing guarantee residual value. That's important because if it did, we'd have to present value that as well. Now, the lessee does not know the amount of the unguaranteed residual value. Okay, that's fine. The lessee does not know the lessor's implicit rate. As a result, so if we would know the implicit rate, we'd use that rate. But we don't, so we're going to use our incremental borrowing rate of 8%, meaning what could we borrow to get this asset at, and our bank will give us 8%. Okay. All right, so now what? Well, how do we figure out is this a lease, or sorry, a finance lease or an operating lease? All right, well, let's go to our criteria. Bargain purchase option. There is no bargain purchase option in this lease, okay? So this is a big X again. So we have to go down to criteria number 2. Okay. What's the useful life? Well, between the initial term, okay, and the purchase, or sorry, not the initial term, but the additional 2 years, okay, so we're already at 5 years. So 3 plus 2 equals 5 years. So that's going to be our useful life. The economic life, okay, in this case, they're saying, the manufacturer is saying that this equipment could likely be used for 8 years. So 12 divided by 8 is going to give us how much? Five divided by 8. I don't know why I said 12. 5 divided by 8. 62.5%. Okay, so it's not really close to anywhere to 75% of that economic useful life. So let's hold tight on this one. So if I'm looking at this right now, using criteria 1 and 2, to me this is a finance lease, but I want to go that extra step. Okay, now I want to know, well, let's just skip to 4. Okay, it's not highly specialized. Okay, so our next option, okay, the last criteria to determine, is this going to be a capital lease, which is also known as a finance lease, or is it going to be an operating lease? Okay, so now we've got to figure out the present value, okay, of those lease payments. So first of all, again, it's a present value of an annuity due. Okay, so the first one is going to be our $20,000 payment. Okay, P over AD, annuity due. So we got to go to the P over AD table in our textbook, which is way back here on page 1679. I would mark it in my book. Used for leases, okay, that require a payment at the beginning of the year. Okay, if you need, maybe you don't, or you'll just remember which table to use. Okay, so from there, what we are going to do, I'm just going to mark that in my textbook as well. Okay, so right now, if we look at the various criteria of this question, again, this is on page, or the examples on page 1252. Okay, so we have we know our interest payment, okay? Our interest rate is going to be 8%, okay? What's the term? Well, the initial term is going to be 3 years. Okay. Now, we're also going to add in the additional $5,000 payments, okay? Now, this calculation is a little more trickier. It's not, once you get the hang of it, it's not. Okay, so this is for the initial term. Okay. Then plus 5,000 P over AD. Okay. Again, 8%, 2 years. Okay. We got to go one step further though. Okay. We also then have to multiply it further by P over F. 8%, 3 years. Okay. This here, we're going to use, this is going to be off our present value table chart, 8%, 3 years. Okay, these are always going to be the same when we have a bargain purchase renewal. Okay, sometimes we might have to go one step further if we have a guaranteed residual value. Let's just say the guaranteed residual value, we had to pay out a guarantee at $10,000 at the end of the lease. If we didn't take it on, we'd have to add in that, say, I don't know, maybe it's $10,000, and we would just figure out the present value, 8% at the end of the lease term, which is 5 years. But we haven't gotten that far yet. Okay, so what I will do then is now I'm going to go to my tables. Okay, so from here we'll go down 20,000 times what? Well, I said you got to go back to your present value tables, right? So for the first 3 payments, we're going to use 3 years at 8%. Okay, so 3 years at 8% is going to give us 2.78326. Plus, now we got to use this information here. This is for this information here, the $5,000 payment is our lease option, okay? So again, if we want to lease it for another 2 years, but we have to figure that out, we have to figure that in as well. Okay, so we'll go $5,000 times, well, first we got to figure out again this here. What's our multiplier? 8% at 2 years. Okay, why 2 years this time? Well, that's the remaining lease option is another 2 years. So 2 years at 8% is going to give us 1.92593. Okay, now we also have to get the multiplier for the to take that back to the present value. Okay, so that $5,000. So we'll go to our first page here, or no, it's not. The very first page of the table, which is on page 1675. Okay. Now we'll go 3 years at 8%. 0.79383. Okay. So by doing this, I mean, we're doing it the long format, but we should get the same calculation that the textbook gets on page 1252. Okay, so let's multiply all these tables, or not all these tables, but all this information. 20,000 times 2.78326 equals 55,665 plus, now we're gonna go 5,000 times 1.92593 times 0.79383. 7644. Okay. Now, the textbooks uses 65,666, so I'm just gonna follow that as well. So in the end, when we add that all together, we get a present value of 63,310. Okay. Well, what does that tell us now? Okay. Well, what are we comparing that 66,310 to in order to figure out, are we going to pay, is our present value of our minimum net payments going to be greater than 90%? Well, what's the fair value of the asset right now? The fair value of the asset is 66,000. So we'll take that 63,310 divided by 66,000, we get 96%, which is greater than 90%. So as a result, we've looked at all our 4 criteria. As a result of it meeting criteria number 3, okay, where the present value of the minimum net lease payments is greater than 90%, this now qualifies as a finance lease. Okay, so now we're going to capitalize this. Okay, so now we're going to go to page 1254. Okay, what happens on page 1254? Well, notice this table. Okay,